You have just one mission in life. Come up with another S&P 500 and say, oh yeah, Terry, we got this. We'll work on it for you. But I don't think anybody will develop something as widely used, widely understood as the S&P 500. And for that reason, it really, I know you talk to some of my old colleagues, they all have their favorite index. This thing, the 500, will outlive us all.
The Phil Bach Podcast. Investing, economics, entrepreneurship.
Welcome back to the Phil Bach Podcast. This is a very special show today. I'm joined by the longtime CEO of S&P Dow Jones, Alex Matturri. Among other notable accomplishments, Alex oversaw the merger between S&P and Dow Jones, among other deals, and guided a massive expansion of the business from passive cap-weighted indexes to new and innovative approaches. We're going to talk about the indexing industry, its impact on the markets, and about managing and growing a business at scale, and more. So, Alex, thank you for joining the podcast.
Oh, it's a pleasure to be here today.
So how are you? What does your lockdown setup look like?
So I've been locked away in my basement. As you know, I retired in June, so it's been an interesting transition into retirement. Having done it virtually, handed off the transition to Dan Draper, who took over for me, doing it all virtually. It's been quite an interesting situation to live through, but just still getting adjusted to life of leisure, as you would say.
Yeah, life of leisure without being able to really enjoy that leisure and go out and do leisurely things. So it got to be tough.
Yeah, that's the best about it is I get to walk a lot and enjoy that part of it until the winter starts coming around. It's starting to get a little chilly here in New Jersey now.
So let's start with your career story and how you came to run S&P.
So I was at Northern Trust prior to joining S&P back in 2007. I was running their index business when I was approached to take over the index business by a man by the name of Devin Sharma, who was at the time running S&P, everything but the rating part of the business. And his goal was to find somebody that actually had come from the customer side. So my whole career has been spent really in asset management. Earlier on, I started out trading options. I eventually got into index fund management at Deutsche Bank, and then we got bought by Northern Trust. So I'd been a user of indices my whole career, really back to the late 80s. And so that was really what intrigued him in terms of somebody to run the business. And really, nobody knew where it would go to back then. It was a much, much smaller business. But his goal was to get somebody that actually understood the products, understood how they were used to help grow the business going forward. And right time, right place, I guess. It was a great time to join the business. I mean, it was a phenomenal business to begin with, but no one, I think back then, this was 2007, had any idea of the scale of what the index industry would turn out to be.
Yeah, the S&P indexes and indexing in general have seen phenomenal growth, particularly in the flagship S&P 500. No doubt you and your team had a huge role in that growth. What are the other factors that you would also attribute that success to?
So I think, look, the trend of growth of indexing certainly predated my joining S&P, right? I mean, this really goes back to the early days, whether it was the launch of derivative contracts on the CME and CBOE, or the use of the first index funds started with John Bogle and the institutional accounts. So the growth of indexing has been there for quite a while. There was certainly you can call it a new phase that took place when ETFs got launched with SPY here in the US and the index up in Canada about a year earlier. So there was this is a trend that people think is fairly recent, but really has been growing. And it's really a function of everything you've heard about the shift from active to passive, the efficiency of index-based products in the broadest scheme, right? So certainly indices like the S&P 500, some of the broad-based indices have been what really drove it. But now the business is so much more than that in terms of the type of exposure that you can capture in many different types of product wrappings. And it's really done a phenomenal job of allowing everyday investors to get access to products that they never could have done before. Done it in a cheap wrapper, in some cases tax efficient if it's ETFs, or just an easier way for people to get exposure and manage their wealth. And so that growth, I think, will continue, but it really dates back to the earliest days of indexing. And I think you're seeing an acceleration, and certainly lately much more in the press about it. But the factors today are the same factors that were in place 20 years ago.
When you look at the size of the assets tied to the S&P, not just ETFs, also SMAs and direct indexing, and then you look at, nearly every liquid option, it seems like is, some sort of derivative or tied directly to the S&P at some point, futures. Are you concerned about the size that it's gotten too big, that it's going to have some sort of negative impact on the markets?
Yeah, it's still, look, it's an important index. It's a very liquid market. I mean, don't forget the S&P indices are primarily like the 500 is a unique index in the sense that, it's the leading index in the leading equity capital market in the world. And it's really become a global index now. If you look at trading volumes of futures and options, something like 20% of the trading comes from outside the US, right? You have investors all over the world that invest in the S&P 500, not just in our indices clearly, but also indices from other index providers. But being number one in the largest equity market helps a lot, clearly. But it's still at the same time, if you look at it in terms of percentage of total assets that are invested, equity assets, it's still relatively small. There's many different types of ways of getting exposure, and that's actually quite healthy because the liquidity cycle around the biggest product like the S&P 500 is quite healthy, right? You've got futures, you have options, you can get exposure many different ways. So that all helps the ecosystem quite a bit. But overall, when you look at the amount index, it's still relatively small. And don't forget, the key to success in indexing as an investment is the low turnover, right? And so most index funds don't trade a lot, right? They hold the positions. That's the whole nature of indexing, is not to do a lot of trading. And so while the assets continue to grow, I think last numbers I saw was something like maybe 15 to 20% of U.S. equities are indexed across all indices. So there's still plenty of room to grow. Clearly, the 500 being a big chunk of that is something that you have to keep an eye on. But it's a very, very liquid market, very, very liquid market. So I think it still has quite a ways to grow. But it is something that when I was running the business, you always had to worry about doing things that don't impact markets negatively because it's so broadly used.
Right. And it's hard when you think about it and you look at the trend and the, indexing is just growing and growing. And, right now it's maybe, not at a point where it's impacting price discovery, but what happens in a theoretical instance where it's 80% of the market or 90% of the market? What is the mechanism for price discovery in that scenario? Is that scenario, and I'm not saying that scenario will happen, but could it happen? And if it does, what happens to the market? It's a real... I've been thinking about this for years, and I can't process. I'm not smart enough to imagine what happens in that scenario. What are your thoughts on that?
So I think, does it ever get to 80%? Probably not, right? There's some natural tipping point where the reason you've seen this growth of indexed assets, and put the trading assets aside, but just like index assets, which are at the core, what's driving that was really people realizing that active management wasn't providing the same returns as the index on a after fee basis, right? And so, initially, who are the first assets to be lost in a scenario like that? Probably the worst performing assets. So as people become much more educated, you've seen the easy money move from active to passive. But there's still a lot of good active managers out there. There's smart hedge funds, right? They're out there. So you're going to get to some tipping point where you get to some level of equilibrium. Where that is, I don't know. The thing to remember, though, again, in terms of price discovery is a function of trading liquidity at the margin, right? And so you can have a lot of assets sitting in an index fund, but price discovery happens when people need to trade at any point in time. And even now, where you look at the amount of assets held in indexed assets, the trading throughout the day, that's not index managers trading, as we all know, right? The index managers trade at the close when you have peak liquidity. And so there is still going to be mechanisms for price discovery, even as assets continue to grow. At some point, sure, in a theoretical sense, markets would freeze if there's no price discovery, but somebody will start to take advantage of it, whether it's a smart hedge fund or somebody that will be able to show value through their investment style and take advantage of an index. And that will find that natural point of equilibrium. Where that is, I don't know. I think John Bogle thought that it could be quite high. I'll leave it for the academics to try to model that. That's a pretty big analysis if you try to figure out where that is. But we're nowhere near that now. And I think there's still a long way to go, especially when you think about it from a global perspective.
Right, right. And one of those mechanisms to be able to take advantage of price fluctuations or any, if the market's ignoring value in certain ways or ignoring other factors, then, that's where I've always loved smart beta investing. And smart beta, of course, is
Yep. I was going to say, even in pure indexing, think about it, not every index follows the same rules, the same rebalance, right? I mean, there's different objectives of indices, right? I mean, how many different indices are there out there now just in the US alone? And so by following different rules, following different rebalance, there'll always be, it's not like everybody's going to trade one single index on one point in time. Probably that's the worst situation. I think the closest you come to that is the Russell, reconstitution every year. And so again, I think concentrating all your trading at one time is probably not too healthy. You want to make sure it's spread out. And that will allow that price discovery. But like you said, smart beta comes in, right? People might have equal weighted strategies. People might have other types of asset allocation shifts that they're going to make. There's always going to be some reason that people will trade. They may still use those index building blocks, but still trade in a different fashion to try to get some different type of exposure.
Right. Yeah. And I, like I said, I have a real affinity for smart beta and factor investing. Most of my career has been either, building or promoting those types of funds. But I think one of the reasons why this issue has really bubbled up late over the last year or two and really been a concern is because we're in this unique market regime where not only is market cap weighted indexes typically cheaper, they've also been outperforming. And, there's a cyclicality to these things, of course. And, you could say that cap weighting is kind of, synonymous in some ways with momentum or even growth on that scale. I don't know if you agree with that or not, but it just seems like lately, the flows beget flows and the performance and the low cost and everything, all the tailwinds are back behind cap weighting. I don't think that'll last. I'm sure, these things are so cyclical that it can't last forever, but it just seems to a lot of people that there is an impact on price discovery. We're seeing the biggest companies just continue to get bigger. So what would you say to people with those concerns?
Well, if you think about the concentration, right? So everybody's been talking about the concentration in the 500 in whether it was the FANG stocks or these sort of very high tech, I don't call them fad stocks because they're legitimate businesses now. That's not coming from index investors, though, right? That's coming from individual investors that are playing the Amazon game, right? That are buying Facebook. Index investors go along for the ride because as their market capitalization grows, but somebody else is bidding that up. That's not being bid up by index investors. But you've got, an index nowadays is pretty broad, as you said, right? You've got equal weighted strategies. Equal weight strategies have been around for lots of years. Now, when you decompose an equal weighted strategy, what do you get, right? You get more of a mid-cap, small-cap bias. You get more of a value bias. You get different characteristics. So, yes, you're going to go through cycles, right? The only true market index really is a total market portfolio. And, of course, nobody really invests in that, right? And so all these other indices are subsets of the market. And there will be times when particular strategies may do better. One type of index may do better than another type of index. Comes down to the methodology. It comes down to the factor exposure. And if other people are driving that factor exposure, it's going to show up in index. Look at the small cap marketplace, right? The Russell 2 and the S&P 600, two small cap indices with very different methodologies. And there's times when, most of the time when the 600 does better than the Russell. It's not that the Russell is necessarily a bad index, but it's just built differently, right? It doesn't have the earnings and quality factors that are built into the 600. So are there times where the Russell is going to outperform? Sure. I would argue that if you're going to be a small cap investor, you do want to invest in something that's going to perform better because you're trying to capture that type of quality performance. And so all these things come together in the marketplace at any one point in time. So you're right. You're going to go through some cycles. If you think about one of the drivers that people forget about, one of the things that drives index performance relative to active managers, most people in an active portfolio have an equally weighted portfolio. At least it starts out that way, right? That's the traditional way where you start investing in 2 or 3% position in a bunch of different names. And so by definition, an active portfolio will always perform differently than a cap weighted index. because the composition's different, the weightings are different. So there's a reason why that underperformance happens. Sure, if these top stocks in the 500 or any of the big indices start underperforming for some reason, you're going to see mid-cap stocks do well. You're going to see small-cap stocks do well. You're going to see value come back into favor. The beauty of it is that you can have index exposure in all of these areas, and people can still make that active decision of where they invest using these sort of index building blocks. And I think that's really where the future of the industry is, in that providing these low-cost building blocks that allow people to take a particular view. And then the asset allocation view, again, is driven by many different factors, right? What your age is, what your investment objective, how much risk you want to take. But you can still use index building blocks for that. And things like factor exposure is just another way of capturing that type of factor products, or just a way of capturing that type of factor exposure that you would get from that. And if that's the bet you want to make, go for it. And there'll be times when that could outperform.
One of the great debates that you see online all the time, people say, well, the S&P is an active fund because of the committee making decisions. And I know that, by and large, about 420 of the 500 stocks will overlap with a rules-based version of top 500 by market cap. But the ones that don't overlap, let's say at any given time, it's between 70 and 90, I think the last time I looked at it, they're typically, really small weights. So the vast majority of the weighting is an overlap with the rules-based. Why not just go to a rules-based top 500 by market cap instead of going with the committee? Of course, now all eyes are on Tesla, and I think that might be a good case in point to how I suspect you'll answer. But, why have that committee in this day and age making that determination about what stocks go in and what stocks don't?
I think one of the kind of naive approaches is it's worked, right? Now, you think about every index has some sort of governance committee. Even a rules-based index still has to have some committee structure, some governance structure to make decisions, whether it be corporate actions. I think what's different with the 500 is that they'll actually make individual stock selection decisions, but it's in a very confined approach. Now, I've never sat through index committee meeting. As being on the commercial side, that's not something that we ever got involved in. But at the end of the day, their job of an index is to be representative of the market that it's trying to achieve, trying to track. So for the 500, you're trying to capture not the 500 largest stocks, but find 500 stocks that represent the large cap portion of the U.S. marketplace within certain rules. Right now, you could argue of whether dual share classes should be included, not included. The non-voting shares. I mean, there's a lot of rules around methodologies. And so a lot of what an index committee really needs to focus on is those sort of rules and the methodology itself. Individual stocks, when you start focusing on the methodology itself, the amount of discretion in individual stocks is really what's representative. A lot of the decision is around, what's going to cause the least amount of turnover, right? Because again, by definition, you're trying to minimize turnover in an index. So there's really a lot less discretion than people might think. Some of it, people forget about. You have to have, I forget, was it four? You have to be profitable in the last 4 quarters, right? I think that's the rule. I don't even remember myself now. But again, these are the rules. These are the things that the committee focuses on, right? And so, by adding something like a Tesla into it, they're not looking at whether Tesla is going to perform better or worse than other stocks in the index. But by adding that amount of Tesla, think about what it does to the index in terms of its weight. What is it going to do in terms of you have to sell down, index managers have to sell down all their other positions. There's a lot of other repercussions of doing things purely mechanically. And it's actually worked quite well by having that knowledge and experience to do the methodology. But it's very little that's really discretionary. Will Tesla be added in? I don't know. At some point you would expect it if it continues to perform the way it has. People can call into questions the quality of their earnings. Again, I'm not looking at it from an analyst standpoint, but how much of their revenue and earnings is coming from tax subsidies and things that are non-recurring, right? I mean, is it real, right? So again, I think the idea is to make sure that it represents the marketplace, and that's really the goal of the index committee. And it's worked quite well, with the idea that these methodologies have to adapt over time, which they will, right? I mean, constantly there will be changes to a methodology, changes to approach. If you remember years back, it was domicile, when all of a sudden, U.S. companies were technically headquartered in Ireland for tax purposes. But were they really Irish companies or are they really U.S. companies? So you need people to make judgments about that. And that's really what the committee should be focused on and is focused on.
Right. And so the committee, is a form of corporate governance on the index itself. What responsibility does the committee have for the companies that are in the index on a government standpoint? And, it's an interesting thing to think about because there's a lot of focus now on ESG. And a lot of people think about it in terms of the ETF issuer, the sponsor, or custodian of the assets. But the allocation decisions are really being made either by rules or by the index committee. But when you talk about ESG, I think people really focus on the S, on the social, more so than the governance. And you can have issues come up where investors in the fund, stakeholders, have conflicting preferences. So it becomes very difficult to navigate in a way where you're responsibly managing the ESG considerations while not alienating, one set of investors versus the other. But the governance side of it itself, in terms of just keeping companies honest and just basic due diligence on the companies, is that something that the index provider has a responsibility to do?
So it's a very complicated question to deal with. At the end of the day, the fiduciary is the fund manager, right? They still have the fiduciary obligation. They'll argue that they're just following the index, but they vote the proxies, right? And they could also engage, and they do. BlackRock, Vanguard, State Street, they're all engaging with the companies themselves. My personal view, and I'd say this is more of a personal view, is that the right approach is to have multiple versions of a particular index, right? You have a baseline index that represents the market, right? These indices, don't forget, take into account through the consultation process views of the market. So if there was call it a consensus that a particular factor should be factored in, an ESG factor should be factored in, that's something that I think an index committee can take into effect. The approach we took, though, was to have an ESG version of the 500 and a standard version of the 500. In fact, multiple ESG versions of the 500. Why? Because you're not going to, I don't think, really get to that real consensus, right? Should thermal coal be included or not? Interesting cases, they recently announced potential changes to the DAX index. And they're actually talking about incorporating elimination of controversial weapons manufacturers out of the index. And it's interesting, this is the first time in a core index that I can think of where something like an ESG factor is being actually used as a screening criteria in the core index rather than call it a parallel index. We'll have to see how this all plays out over time. But the problem with ESG is that it means something different to everybody. Even defining some of the environmental issues, it's hard as an index provider to say, this is our view and we're right and you're wrong. I think there's not that real consensus yet. Now, people will follow it because, if S&P does it, people will say, well, maybe that's what I should do because guess what? I can check the box. Somebody else does all the work for me. But at the end of the day, if you're a fund manager, you're the fiduciary, right? And if you don't agree with a particular index provider's view on which should be included or excluded in an index, nothing stops you from going to another index provider, right? There's choice out there. And I think I would call it the American approach is more to give people choice. Europe is a little bit different where you have regulators trying to impose what definitions there are in terms of carbon and what's carbon efficient and not. And that's it's hard to swallow if you're an American. I think it's a very European approach to things. But also, you're going to run into problems, right? Who's to say that is the right number, whether it's the percentage of revenue that has to be excluded or certain companies that have to be included or excluded. It's a slippery slope when you start doing that. So I don't know where it's all going to end up. I think the importance with ESG is that investors need to understand how the index is constructed and how the product is constructed. You can't just look at the name of these products in the indices. You have to really do your homework because, as I said, just with the S&P 500, there's 3 or 4 different versions out there now in products, all with different nuances in terms of what's either being excluded, the amount of tracking error, how much ESG is being factored into the index construction. So it's an interesting area. I think certainly index providers play an important role in that. But I don't think, they're the only role provider. Really, it has to be a combination of what the marketplace deems should be included or not included. In some cases, in some markets, it may be coming from regulators, right, that are going to force it. Although I think in the U.S., if anything, it'll be more regulators forcing disclosure to get better data. Because I think right now that's one of the problems in ESG is the quality of the data is just not quite good yet.
Yeah. Well, I've asked some tough questions, put you on the hot spot a little bit. So let's go to a fun one here. What is your favorite S&P index?
Oh, I'd have to say the 500, only because it's when you spend enough time in this space, you come to realize what a phenomenal index the S&P 500 is, right? And people could laugh at, well, this index has been around a long time, but yeah, it has been. But when you see the amount of usage of it, and I spent a lot of my time when I was working traveling globally. It's the first truly global index. So even though it represents the U.S. marketplace, one time I walked into a meeting in China with the Chinese Social Security Fund. We started having a conversation, and they have a $30 billion investment in the S&P 500 index funds, right? In China. It's mind-boggling that a U.S. index has such a large use even in China. Why is that important, right? Clearly, as they look to move away from their home country, everybody looks to the U.S., so a portion of that. But there's no other index out there that has the ecosystem that's been built, the amount of derivatives that trade, the way you can get exposure in so many different, wrappers, whether it be ETFs, structured products, insurance products, index options, futures, options on futures. The acceptance of that index as a basis for investment products is really mind-boggling when you think about it. And it's just, clearly when it was developed, I don't think anybody realized that it would turn into that. And, it's interesting when you look back at, what indices have grown and been successful and which ones haven't, clearly S&P owns two of the iconic indices, right? Both the Dow, which never achieved that status, so certainly has the headline value, and then the 500, which really achieved that, which was, kind of the second to market index, and you've seen that in a lot of other indices, right? That the first to market isn't always the one that gets the real traction. And, I think with the 500, because it was liquid enough, broad enough, was both a benchmark and a traded product, and became the basis for some of the most liquid traded derivatives and ETFs, even though in many cases, it wasn't the first futures contract, that was a value line index. It wasn't the first index that SIBO spent a lot of time working on. It was the OEX, the S&P 100. But it's the one that survived all of them, right? And that's pretty phenomenal when you think about it in terms of an index. Remember when I first joined S&P, Terry McGraw used to talk about a story that he said, because you guys, you have just one mission in life. Come up with another S&P 500. I said, oh yeah, Terry, we got this. We'll work on it for you. So, we did, I think at our peak, we had about 1 million indices out there, but I don't think anybody will develop something as widely used, widely understood as the S&P 500. And for that reason, it really, I know you talk to some of my old colleagues, they all have their favorite index. This thing, the 500, will outlive us all.
Yeah. Well, it's an incredible brand, and S&P itself is an incredible brand, and the 500 is an amazing brand. When you talk about a brand, a lot of people think about, luxury retail goods or a car or, something more tangible. With an index, which is, really more theoretical or just, a list, a spreadsheet of stocks in some cases, how do you build that brand? How do you, what is it that makes an index a quality brand or not for an index?
And brand is very, very important because at the end of the day, when you think about what an index is, right, at least in the equity space, what differentiates the index, it's not the pricing, right? Because all the indices, if it's based on U.S. equities, we're all using the same prices coming from the same exchanges, whether it's the composite price or single exchange price. I mean, for all intents and purposes, we're all using the same price. Typically, at the end of the day, you're all using the same closing price for that. And an index itself, conceptually, is just a weighting scheme and a price summed up, right? Not very hard. But what really distinguishes it is that brand and what that brand stands for. And I think that brand goes much beyond just the product brand, although product brands become very, very important. It's also the organization that stands behind that. And I think, having been in the money management world for years, where I never worked for the number one player in a particular market. I was always the number 3 of this, the number 2 of that, or right behind the number 1 guy. And so you go into meetings with sales meetings or prospect meetings or with clients, and you'd spend the first 10 minutes explaining why you're as good as the bigger guys. And with S&P, that never happened because S&P had that brand value. Now, it also helps that the rating agency was big, right? So you shared a brand with the rating agency, but people understood the difference between S&P ratings and S&P indices. But that brand and protecting that brand meant a lot to us. And we spent a lot of time and effort cultivating that brand and what it stood for. We talked about earlier the index governance process. That's part of the brand. That's what S&P stands for, right? The fact that we have indices across the world and how we support them in the marketplace. That's part of the brand, and that's what you get when you get an S&P index. The separation, we always talk about the separation of church and state. David Blitzer, who for years ran the governance side of the business, that was in place years and years ago, well before regulation came into the index industry. And people understood that. People understood what the brand stood for. And so protecting that brand also meant making sure you don't do things that impact the brand in a negative way. Who do you partner with? We would spend a lot of time debating who we would license our indices to make sure that they're not going to do something that's going to show up on the front page of the Wall Street Journal, as the old adage is, right? Because people do rely on it. Making sure that, we can calculate our indices 24/7, right? That became part of the brand, and that's what people look for. So, spending a lot of time in terms of educating the marketplace or marketing efforts, things we do like around SPIVA that help educate the marketplace. We all think that that's part of our brand building exercise. But that's really what stands S&P apart from some of the other index providers who, quite honestly, will ride on our coattails for that. A lot of the index providers have benefited from the work we've done around passive active. But again, it's something that we thought as an industry leader, that's what we stood for, to make sure that our indices are transparent, they're well understood, the methodologies are out there, they're replicable, and therefore usable by the marketplace. And I think that's one of the reasons why we've had the success we've had over the years.
Yeah. Yep. When you look around a little more broadly, you look around the indexing and the asset management business in general, you see a lot of consolidation and a lot of fee pressure. Recently, the mergers have been really escalating. Just recently, of course, Morgan Stanley acquiring Eaton Vance. We had Legg and Templeton merge. We had Invesco acquire the Guggenheim ETF business, and then Oppenheimer, Janus and Henderson. And on the indexing side, you've got FTSE and Russell, of course, your deal with Dow Jones. It seems like fewer and fewer big names in the asset management space and the indexing space. There's still lots of mergers, I think, that we're going to see more consolidation as fee pressure and everyone's trying to reach the same economies of scale. What are your thoughts on that and on the future of the asset management and indexing industry?
So let's unbundle that and talk first about on the asset management side. I think the need for active managers to consolidate is really a function of solving the wrong problem, right? Which is the performance is bad. Merging two asset managers that have underperforming products or products that don't suit what their clients want doesn't solve that problem. It buys you time because you can consolidate and get the cost synergies out of it. And so I think a lot of what you're seeing in the asset management side is just that, people want to scale up, have products across the spectrum. Everybody's dying to get into the private markets because the fees are much higher there. So whether it be private equity or hedge funds or venture capital. So they all want to be in the private markets to make up for the flows out of the actively managed portfolios. Clearly, when you look at index managers, it's a scale game. Fees are tiny. And so the only way you could do it right is to have huge scale. And, are you going to get to that in the ETF space? Probably. We're getting there now, right? You have three big ETF providers. Most of them, I guess all of the big three, all have traditional index businesses also. So they have 40 Act funds, they have institutional businesses, and they have ETF businesses that all shares that same scalable platform. I think that business to be the number 10 index manager is going to be tough. So I think in the traditional fund space, that's a tough place to be in. With ETFs, you got enough different products and different distribution channels. So again, you'll have plenty of survivors, but there'll be continued consolidation, and I think the big will get bigger.
Well, I like to close with this question, which is tell me an obstacle that you've had either in your personal life or your career that you've either found a way to work around or just persisted through?
So I guess one of the lessons I learned, and this, so I was at Deutsche Asset Management during 9/11, and I was part of their index management team. And thankfully, we were all okay. I mean, Deutsche was across the street from the Trade Center, so while we lost our building, we didn't have any of the deaths that people had that were actually in the Trade Center. But I learned a big personal lesson in terms of how to deal with a crisis like that, because we couldn't trade for 2 or 3 days. Back in those days, everybody had backup trading sites, but you had to get to them. And when you got to it, our backup trading site was in New Jersey, which again, fine for me because I lived in New Jersey, but was very hard to get to. And you get there and all of a sudden you looked at a bunch of basically card tables with 10-year-old PCs on it that hadn't been turned on. And that was disaster recovery in those days. And if the markets were open the day after 9/11, we wouldn't have been able to trade. And we were running the funds for Fidelity and a lot of big institutional collective funds. We would have been in trouble. And so from that, I learned a lot about how to worry about things that are uncontrollable, if you will, and DR and contingency planning. And that served us well, like when we were going through the combination with Dow after we had set up the JV. It was the same time that the hurricane hit New York and we lost our building in New York City. And we were out of 55 Water Street for a couple of months, 2-3 months. But we never missed a beat because we had built an infrastructure that was totally virtual. And, we at the time appreciated that, again, having a lot of people that commuted into New York City, having lived through what happens if you can't get to your office, how do you make sure you can continue to calculate these indices? We built an infrastructure that was very resilient so that people could do everything from home. And that served us well again now during the pandemic, because we learned that, an index business is really a 24/7 business. We're calculating and monitoring markets all over the world. It used to literally be 7 days a week. Now, the Mideast, there is one day off in the Mideast, doesn't overlap totally anymore. But that lesson from 9/11 of how do you make sure, A, your people are fine, that you can continue to drive what your customers want, because your customers aren't necessarily in the same city as you are. And so they don't know what you're going through. And you're in a capital market business that has to be up and running 24/7. And the exchanges have learned the same thing, right? They operate whether they're no longer have a physical location. And we had to build our business around that also. And so that was something that I learned. And, again, you saw it back in March. Some of the index providers had some problems trying to rebalance because of everything that was going on in the markets. And our systems were pretty robust. We made some decisions on not to rebalance, but that was really around what was going on in the markets and our customers, not because we couldn't do anything ourselves. And I think that's something you learn a lesson like that, and you test it and test it and test it and test it so that your customers can rely on you. And that goes back to the brand, right? People could rely on S&P to continue to calculate no matter what. Multiple data centers, and I can go through a whole litany of things that we've done over the years to make sure that our business is very resilient on a day-to-day basis, because so much is traded on the 500 and used by the 500 globally.
Yeah, well, it's an incredible legacy, an incredible, just really amazing business and growth that you've had. So, thank you for joining the show. Congratulations on everything you've accomplished. And thank you to our audience for your time and attention. Please subscribe, share, review, all that stuff. And we will be back on next week.
Thank you for listening to the Phil Bach Podcast. If you enjoyed the show, please take a moment to drop a review. This show was published for entertainment purposes only and is not investment advice. Please contact a licensed professional before making any investments. Some of the securities discussed on the show may be owned by its participants. Opinions expressed on the show may not reflect those of their employers. Stay hungry and stay foolish.